G'day, ladies and gentlemen, and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon. I'm joined by my all-round good bloke and legend of a mate, Jimmy Ibrahim. How are you, buddy?
G'day, Sammy boy.
How are you, mate?
Good to be back. I'm good.
Very good to have you back,
Great
mate.
to be back. Gee, it's hot up here.
It is. It's good, mate. It's good. What do you mean it's hot?
Paradise.
It's good. It's very good, mate. Nice and warm. Get a bit of colour in you for once.
I am loving the studio. I thought we were trialling this the other time, but now you've
mate, we've
the
had
Miami view.
So much sunshine. We're just sticking with it, mate. Why not? It's a good backdrop.
Why not? Why
Mate,
not?
We've
How
got
are you?
Mate, I'm very well, thanks, buddy. I'm very well. Man, we've got a topic I'm very excited about today. It's one of my favourite types of investment style of property and style of, I guess, investment that I like to go out there and purchase, both for myself and for clients. But firstly, mate, I just want to reach out to the listeners for a second. Those of you that aren't listening all the way to the end, there's something I want to ask for you. And there's a big reason for it. It's taking value from the episode. I want to make sure listeners are doing two things for me. I just ask for two little things, right, mate? That's it.
He doesn't
That's
ask for much.
Don't ask for much. The first thing, if you're enjoying it, please subscribe. I'd greatly appreciate it. Second thing, guys, the big one on this one is all about building your circle of influence. You know I'm always talking about it. And if you're not listening to the end of the eps, I run through this a couple of times, right? If you are listening to this sort of stuff, there's anyone in your circle of influence or your immediate vicinity or friends or family or whatever, colleague, partner, whatever, that you think would take value out of some of these episodes, I think it's a really good idea to send them on. Be it this app or another app you may have listened to before that you think might relate really key or really, similarly or closely to someone that you're in close proximity with. The reason I say to share it is because the more people in your circle that start thinking along the same way as you and start getting that same mindset and keep pushing and driving with you and everything as well, the more people you have on cue like that around you, the easier it's going to be for you to grow and build and have those conversations with people that are thinking very much along the same vein of you. So, guys, anyone out there's doing it, and I've had a lot of people reaching out to me going, mate, it was the best thing I did. Now I'm having all these chats with people that were in my circle that I didn't even really realise, like we're kind of having a look at property as well. Now we'll listen to the potty, we're getting all these ideas and we're coming up with all this stuff and we're having chats and all the rest of it. So it's just to help you guys as well, as obviously I want to keep building this platform, this community of people that are taking a lot of value out of this, and we're all thinking on the same page. So I want to build this thing community-wise as big as we can. So if you could do that for me, guys, those two things, give us a subscribe and send this thing on to anyone you think would take value out of this episode. It'd be massively appreciated.
And you know why? Especially for this episode, Sammy
Tell me,
boy,
mate. Tell me.
If there is ever an episode you want to be sharing with your friends and family, especially if they haven't started their investment journey, this is it.
Mate, especially if they love food, because it's almost a topic of food.
Well, you do love food more than most.
Food. Yeah.
The baklava is you should do the baklava deal. What is that? Because this is the bread and butter deal.
Yeah, the baklava deal. I don't know. Maybe it's the new name for a development deal. You got the manufactured cash, you got bread and butters. Maybe the baklava deal is the one of the. Maybe it's the commercial deal. That's a sweet shop.
Ooh, the sweet deal.
That's a sweet deal. That's a sweet deal.
No, but this deal in particular,
yes.
I really do like it. And
so to recap, guys, it is the bread and butter deal is what we're covering off today. I know Jimmy loves them because he's a turned man. He didn't like them until I fully explained it. Now he's turned the other way.
He's holding it against me, folks, because early in my investment journey with Sammy Boy, I did question him on the bread and butter because I was very fortunate to execute a different strategy. And he said, you got to do a bread and butter. And I said, what do you know?
Righto, Gandalf. Know everything
I'm trying to get him back. We have had some comments back about some of your comments to me from previous episodes.
So much love. So much love for me giving you shit.
We are getting, a few of them said, Jimmy, don't be this. You
need to read them out by hand because apparently you're forgetting what they are.
Nah, in all seriousness,
silver dog.
Yes, the silver dog. It's got a big bite. So you just be careful there, mate.
Okay.
I'm going to keep you on notice on today's episode.
Is that with the little flicks coming out of the hair?
A little tuft. It's a little tuft.
Beautiful.
But the bread and butter deals are critically important, and I love these deals because they.
You've been shown the light.
I have been shown the light, and they achieve so many different things and so many different facets, and they are absolutely critical. I know you got a lot to get through, but just in terms of sharing it, this is an episode you do want to be passing on to your friends and family because, folks, they do say you're the average of the 5 people that you do hang around the most. So if you want to improve your circle, you could be the spark to get people going.
And if you're building them up as well, it means people that you care about and that you like are going to be building along the journey with you.
Absolutely.
You don't need to leave them behind.
Absolutely.
which can happen.
So let's get into it.
Mate, what's your take on them? I love them.
Mate, I love these.
A perfectly timed and a perfectly executed bread and butter. My honest opinion, mate, there is no more powerful strategy out there than a perfectly executed and timed bread and butter. Because if you buy in at the right time and you buy at the right price, and you're at the absolute bottom, you make a discount on the way in, you ride the market to the peak and you sell it down.
Can I give you my insight on what I think a bread and butter deal is?
I just finished the potty, man. I just explained exactly what it was. If you want to know, just go back to Liam Montgomery's buddy a few eps ago.
Yeah, but you sort of glazed over it as you often do.
Your eyes glazed over a bit there, mate.
But they did because you were talking. Yeah. And
come on, mate. You can't tell one joke and then lose it.
They are growth, essentially. We are buying them in good growth locations. They're your growth. They're your foundational properties. If you look at building terms, they're the foundational piers of a building.
Wow.
Or the pillars. You want to really build out your foundational properties. And often people want to go straight for high cash flow.
Cash flow. They want the cash flow, yeah.
But they don't understand that these properties are generally going to be your first few, at least.
They are the
foundations.
foundations. 100%, man. They're definitely the foundations. I know you stole that off me. That's trademarked,
I think it's
proprietary
another buyer's agent.
Definitely not.
Yeah.
But
much better looking.
Sammy, who definitely wasn't you. But you're definitely right. The foundations are always built on the top of bread and butters. You can build it through other ways, but it takes so long. Like your cash flow deals, if you go down those first, they're great deals and I love them. But there's a reason why they come into your portfolio further on. And it's purely because they're so capital intensive, and so often you don't get the big equity uplift on the back of them. You can sometimes, depending on the right market and whatnot, but really what you're wanting to be doing is building your foundations of the portfolio with these deals. They're lower capital. They're easier to recycle your capital back out. They're not too hectic on serviceability, even though, your yields aren't through the roof, but they're foundations that you build your portfolio on before you start leveraging into other properties.
So we're basically saying we want to buy in a good, strong growth location and we want to get that uplift. Obviously, there's a few factors which I'm sure you're going to run through what typifies them. But some people get confused because previously when interest rates were quite low, a lot of the bread and butter deals were also positive cash flow, weren't they?
Yeah.
Right?
Yeah, they were.
But now when we talk about cash flow, right? When we talk about cash flow, we're talking about manufactured cash flow deals, aren't we? So I think it's very important just to clarify. Can you clarify for people essentially, when we're looking at these deals, we're talking bread and butter that are more often than not neutrally geared in a sense. And in this current environment,
with the current interest rate rise we've just
slightly
had.
negative. Is that fair to say?
Yes, mate. Yeah, it is.
Yeah, because I just want to, for people out there, a bread and butter deal could still be cash flow positive. It's just a very specific type of cash flow, what we're talking about when we talk about manufactured cash flow.
Definitely. So there's a different thing, right? And the next potty we're going to be recording that we're going to be running through is going to be on the manufactured cash flow deal. So if you want to see the difference between the two, that's the potty to listen to on this one. But the whole idea of those are to provide excess cash flow, right? For serviceability, for end game, all the rest of it. The whole idea of the bread and butters is to build the foundations to be able to leverage you into cash flow deals.
Yes.
As well as to continue building the foundations of the bread and butters. We're going to also do a podcast at some point on the exit strategy. Now, the exit strategy is hugely important. Bread and butters make up the bulk of an exit strategy. They are so important. And that's why I think, man, like there's a few key pillars in terms of them that are really the reason why they're in the portfolio. The main one, I know we've said this about 10 times now, but it's building the foundations, being a building block. Like
so scaling out, essentially, scaling out.
Exactly, man. So let's say you might put 70 grand into a deal and then you make 25 on the way in, you have 10% growth, bang, in 6-12 months, you're pulling your 70 grand back out, you're rolling into another deal. It's a very scalable, repeatable process. And then when you've got two of them in 6-12 months, you're coming back and you're pulling equity from both of them. And again, making discount on the way in, growth, you can build it like that. Obviously, serviceability dependent. But that's where when you start on these deals and you build these deals out as a foundation of your portfolio, when you start nearing serviceability ceilings and walls and whatnot, that's when you start, okay, well, the next chunk of equity we're going to pull out, we're going to roll it into a cash flow deal, boost the serviceability and keep moving forward. But that's where these are super crucial because like the other thing is when you go to a cash flow deal, you go to a development or whatever you go and do that's a more capital intensive project, that might take you out of the market for potentially, 12 months, 18 months, depending on the deal you go and execute. If you've got 3 or 4 bread and butter deals worth, could be $300,000, $400,000, $500,000 each in the portfolio, let's call it anywhere between $1 to $2 million worth of property in the portfolio. if you're getting a 10, 15% growth rate on a mill, you're making 100 to 150 grand a year net, like in terms of equity that you can pull out and keep building the portfolio with. If you've gotten to a 2 mil portfolio, we're talking $200,000 to $300,000 a year, and that's compounding. That's growing every year. So what you see, and when I did the portfolio breakdown a few weeks ago as well, remember we were looking at, okay, well, this is the portfolio that was predominantly built as bread and butters at that point for my first 10-ish sort of thing, 7, 8 or whatever. They were all done that. And you look at them in terms of purchase price of what they are, it was 2 mil. And then at the back end, like all that time later, there was over 5 mil that had been generated by that compounding. And I was off doing other shit. They were just sitting there doing their thing.
Yes.
But that's what they'd gotten to. And they'd created me that much more, circa 150% growth in that window since ownership.
Okay.
And that's where, like, you let them grow, you let them do their thing, and that's what they're perfect for.
And can we say the other reason why people really start out with these ones is because when you're trying to build out equity and you're starting out, more often than not, people only have their initial capital to start with. So that's why you're not really too focused on trying to create cash flow in a sense.
It's not the right time.
You need to create chunks of equity to use. If you don't have equity, that's what you need to be doing.
Yeah.
So I think for people's mindset, they need to understand.
Yeah. It's super important to build out that base. And if you got, even in your second deal, if you were to pull it out and go to a cash flow deal, you're probably going to get stopped. Or at least you're going to stall until that thing's finished, which could be 12 to 18 months. But you can keep recycling and build them. I hope that made sense of what I was saying before.
I think so. Yeah, absolutely.
I know I talk a bit quick sometimes, but then you're jumping and you're leveraging into deal after deal and you're stripping capital, rolling to the next one. You can definitely multiply it from that side.
100%. All right, so run me through what you've got, because I know you've been working on this. I know you love your bread and butter deals.
Yeah. I'm working on it. I'm pretty much running on the fly with this, really. Running on the fly.
Well, let's go through some of the factors of the bread and butter deal,
so the big key points of really for me, like we said 11 times now, foundations, that's your big one.
Big one.
The whole idea of having them in here, and this is opportunity cost of doing a different deal type and taking time and executing all the rest of it that take you out of the market. It's riding the growth wave. So you want to get... It's one of the things I learned really, really early on. I can never remember who I read this that wrote this, but someone I read said, you want to acquire and accumulate as much property as you can in a market before it booms. If you carry a solid amount of property, and if you can make a margin on the way into, let's say 2-3 deals in a market, and then it goes and it has an exceptional run for 3-4 years and your values double. If you had gone and done one cash flow deal or one commercial deal and maxed out all your deposit at the very start, and that had maxed you out of that, you would have missed out on doing 3 or 4 deals, let's call it 1.5 mil, that then goes to 2.5, 3 mil in terms of value. That completely sets your entire portfolio up to be able to go to a different level. So that's where you want to position yourself really early into these growth markets. And that's the key. Get a discount on the way into a market that's either booming or at the very bottom of the cycle and it's about to take off. That can sometimes be quite counter-cyclical thinking to go and buy in those sort of areas. But that's where you want to position yourself to get the absolute maximum amount of a deal out of a deal like this and then ride that market to its peak. And the third point, let me say the third point. For me, these are my 3 points. You got your foundations, you're riding your run, right? You're riding your growth wave, you're picking a market correctly. And then number 3 is your exit. Like I said before, this fully formulates your exit strategy, like so much of your exit. I mean, at the back end of some of our clients' portfolios, you and I have both done this as well. We have developments that come in, they're for accelerated sell downs and pay down strategies and whatnot. But your exit strategy is the quickest way to be able to de-risk and de-leverage and reduce debt from your portfolio, especially if you've leveraged a few of these things up, done a few equity releases to keep building the portfolio. Again, go back to that, Liam portfolio from a few months ago, whatever it was, a couple of months ago. You go back to that one and you run through that. What he did on that first deal, he bought it for 190, sold out less than 3 years later for 390. He's done about 105% growth in a 3-year window, made a discount, timed the bottom, sold it at the peak, walked away, went into the next deal, started building his portfolio on a very different level to where he was at the time.
Yes. Okay. So essentially, just in summary of that, because you did, I think you've nailed that. So you're basically saying we could wrap this up.
Almost.
So you're essentially saying the whole purpose of these deals and the bread and butter deals is to scale out your portfolio. And then once they've gone through a really strong growth cycle or the market has peaked, then we're going to look to sell down, to pay down, use those properties to do all the heavy lifting for us.
Yep.
And then pay down debt against more of our other properties that we want to keep.
Yes. Yeah, 100%.
So the factors of a bread and butter deal. If someone that's at home thinking to themselves, okay, well, how do I go and find one? So first key thing, good, strong growth location. Market's
your first thing. So you've always got key factors on these deals, right? Yes. Right location, right price, right property. So Ooh, right property. So this is...
Oh, there was a little bit of thrashing there. Gee, little trigger.
No, right property really comes down to... I'm going to do a comparison on this. The comparison of buying the wrong property in the right market, right? So in the sense of like, let's say you go buy a house or a unit or a townhouse or something in a market that is dominated and it's going to have better, or maybe not dominate, maybe there's too many units and townhouses and that's why they're not going to grow. But I have a great comparison story and something like this, and I'm going to be raw with this. It's within my own portfolio. I'm going to do a breakdown and an analysis on this thing and why the house, almost exactly the same market, literally same city, not that far from each other. The house saw over 100% growth in a 3-year window and the unit saw about 30, right? Wow. So we'll cut to that in another time, right?
All right, yep.
But right, what did I say? Right location, right price, right property. So right location, we've already run through right property, right? So we'll work backwards.
Yeah, so you don't want to. You can't be, can't be expecting a unit to be a bread and butter deal. Is that what you're saying? Essentially,
it depends, man. Units almost always underperform.
That's what I'm saying.
They almost always underperform, and that's why I'm going to do this analysis of 2 deals of almost exactly the same market and showing the way that they do underperform in that sense. Okay. But yeah, man, like when it comes down to
on a separate podcast,
we're on a separate podcast. But that's where like so often that asset selection, like people hear, wherever Wollongong's going to have a great run. Like in COVID, I'm predicting Wollongong's going to have a great run. We did the portfolio breakdown not long ago, and the old unit that I sold, that first property I ever sold, I sold that thing. It's only gone up 100, 150 since I sold it, which was a COVID-driven boom for it, which was probably 30%. But the houses in the same market would have done over 100% growth in that same 2.5-year window because there was so much demand for it. Okay. And it's just like, you buy that wrong asset type in the right, it could be the right market, but you buy the wrong asset type in it because someone's trying to flog, that for whatever reason, that can really come back to bite you in the ass. So right asset is, right property type is very, very important conversation. Okay.
So I get that. So obviously a bread and butter deal, essentially, if you're thinking of it as a growth property, if you're relying on your property to grow in 20 years or something, then it could consider to be a growth property. But what we're talking about is a really good bread and butter deal allows you to scale out. Yes. So it has to be giving you the results relatively quickly.
And that's why the other 2 points, right? So right location, right property, right price. If we go back to right price, right, the big thing about that is making a margin on the way in. So there's, and you'll see plenty of other BAs out there telling you, buy market value, all the rest of sort of thing. As long as you're in the right location, it'll do the heavy lifting, which it's true in a sense, but like if you're paying someone for that service, or if you're out there trying to do it, if you want to scale, if you want to build your portfolio, get the biggest return, the biggest bang for buck on what you're doing, you need to get a discount. If you're not getting a discount, you're paying market value, like, you're cheating yourself. You should be doing a lot better than that. You should be holding yourself more accountable, especially if you're listening to this podcast. You should be holding yourself more accountable to the process than that, because that can leverage you and scale you a lot quicker than not doing it, especially if you are deposit poor. You might be deposit poor, whatever the other side of the equation is. If you're deposit equity poor, you need to make sure you're making as much as you can on the way in, which leads me into obviously point number one, the most important, the most crucial part of it is buying the right property in the right location.
The market, yeah.
If you're getting in the right location and you're timing the entry to that market at the right time, and that could be for whatever reason you're getting into a certain market. It was like when we got into Brizzy, everyone at that time was saying, don't get into Brizzy. Like or don't get into especially certain markets within Brizzy. It wasn't going to perform. It was going to be shit. We bought that.
Hasn't done anything for ages.
Hasn't done anything for 12
Remember
years.
Someone hit you up with that? What's going on? Mate, this property's hasn't done anything.
Why would I buy
what I
this
said
thing?
to you?
Yeah, you probably did. Bloody goose. But so often that was actually what was said to me. Again, what I said a couple of minutes ago was countercyclical thinking, going against the grain of what everyone else is talking about, which is what this is all about. And when you invest with a countercyclical mind, it can be scary, really scary when you first start. And that's totally okay if the listeners have gone through this before, because I have as well. It is a hard thing to do to invest where other people don't tell you to invest. That's like investing in a time where everyone says you shouldn't be buying right now. You should be sitting on the sidelines. 9 times out of 10, my experience of almost 15 years now of bloody investing is you want to buy in those times. You want to buy providing everything else stacks up. You want to buy when no one else is talking about it, or they're saying that it's shit.
Yes.
They're saying, it's terrible. It hasn't grown for 12 years. Yeah, mad. All the other indicators are there. That's one of the reasons why I'm buying there. So you time all those things in properly in perfection, especially obviously location is the big one. We get that right. It will do the majority of the heavy lifting for you. So they're really the key elements, Key elements for bread and butter. Buy the right property at the right price in the right location. That's your key 3 principles for a bread and butter deal.
Okay. And what about for people out there that are thinking to themselves, can a new house and land or something like that be considered a bread and butter deal? Or, I mean, everyone's got in their own mind, well, it's in a growth location. It's going to grow. I think they're missing the opportunity cost of the velocity of money, which you talk about moving money into subsequent deals.
Yep.
So do you find that that's where a lot of people go wrong?
Yeah, I mean, that's asset type, right?
Yeah.
So it's buying like house and lands or buying units or townhouses or whatever, they get the location right, but they buy the wrong asset type. And if you're buying a house and land, someone's probably got a 40, 50K com built into it, regardless of whether it's coming from a financial advisor, an accountant, a broker, or you're buying it direct off the street sort of thing. Someone's clip is in that deal. Developers clip and everything as well. So often you're not making the margin on that. What you want to be targeting is like established product that you can negotiate a heavy discount on, or depending on the market you're in at the time. If the market's already heated up, it might not be a heavy discount, but it might be a decent discount, that keeps you moving.
I think the established market is a really important point because a lot of people don't understand that in a sense, like, okay, but it's brand new and in an established. The reason why, can you explain to people why we want to buy in established markets? The main reasons why we're targeting areas that we know what the numbers are.
So the main reason for established is purely because you can't really, like, unless a market is screwed, you can't really negotiate a discount of house and lands, right?
Correct.
Anyone that really tells you that, they're probably selling 100 of them in a big package to everyone, and I'll tell you, there's no discounts in there. They're taking clips on the way through.
Or they think they're getting a discount on stamp duty or something.
Yeah, just don't do it. Like just simple. Unless you're sourcing the land yourself and building it yourself, and you can see the margin. Like you can buy the land for this, you can build for this. The end product value is this, and I'm not talking about house and land. I'm talking about you sourcing the land, you sourcing the builder, knowing the end product value. There is value in that. We've obviously covered that in other episodes myself. There's value in it if you know what you're doing, but they're very slim. There's not that many of them around, and they're hard to find, especially in a market like this. Established, you can find comparables very easily, just for a really simple, easy explanation, like a 4x2 in your standard suburb that you think everything points towards growth for this location. I'm comfortable with this location. This is a great bread and butter area. It's a 4x2, sort of style stock in this area. Standard finished home sells on average for $400,000, and I've got one here for $375,000. But it's exactly the same as next door just sold for $400,000, down the street sold for $395,000, and there's one direct, a couple of doors down behind me that sold for $405,000. So my market value is circa $400K, and I'm buying this thing for $375,000. Bang.
Happy days.
You can pull your comparables really easily. Yes. And a lot of the time, as long as there aren't, got to be careful as well. This is where people make a mistake. They talk themselves into thinking, it's the same, it's a great deal. And those have got, Caesar stone bench tops and really nice finishes the whole way throughout the home. They are freshly repainted and carpet. They look amazing. And yours is an ex rental of 10 years with laminate bench tops and looks like shit. That's not a comparable. Yours is $25K cheaper for a reason. You got to be careful. You're not buying something cheap. That's cheap for a reason. The discount and the comparable properties are the same.
That's a really good point, Sammy. That's the first good point of the day.
Thank you, mate. No. Are you going to throw one in at some point in this whole series, or?
Well, you are the host of the show, so I'm just the sidekick, the better looking one
with the grey tuft.
The
grey tuft.
I've got it's interesting because not all properties, and I think we're trying to really emphasize the point that not all properties are the same. Because I've mentioned this previously. That one of the properties that I bought it was supposed to be a growth property from a previous buyer's agent. Yes. The one that I bought 10 k's north of the city, and that property didn't grow at all. So don't get confused on thinking a good asset is actually still going to be like a good property is a good investment, because that property didn't grow for about 5 years. And if anything, it's in a really good location. It's close to the city. It's probably the nicest property that I own in terms of visually looking at it, but it's the worst performing property.
Yeah.
So that's not what I would consider. I mean, now it's a bread and butter deal. I've held it for 7 years and I'm going to sell it. It ticks the box of a bread and butter deal for me now, because I'm going to sell it in the end to down pay debt. Yeah. And that's the only reason why.
Yeah.
So I think for people listening out there, it's just don't get confused as to what we're talking about.
Yep.
It's got to meet a specific type of criteria.
Yep.
It has to be in a good growth location. You want to be buying it at a discount on the way in. It can't be draining your serviceability. So it's not going to be heavily negatively geared or anything. In this current environment, it might be slightly negative, but the whole point of it is to scale and continue to build. That's it.
100%. one other big thing I'd throw in on it as well. Is there anything else you want to throw in on that?
No,
stuff?
I think just, I know we're laboring the point, but I think it's really important.
Yeah,
and the basics with investing, we don't need to reinvent the wheel. You just got to re-emphasize to yourself. And I keep reminding myself too about this. It just reinforces the message about why we're buying these.
Yeah, you're a slow learner. Yeah. What's wrong?
That's good for you.
Thank you, man.
Good.
Thank you.
That's good. So your point?
Yeah, I was going to say the other big thing on them as well, the one that people really have to take into account and consideration. There's one big thing. It's like a bit of a myth. We should do like a busting myths or something on these things, because so often people talk about, oh, you want to carry your growth properties through 2 cycles, right? And like, what kills me about it is, especially I see these people that are like big, like blue chip sort of style assets, and they're heavily negative and like, oh, carry it through 2 growth cycles, and it's like, if you have to wait another 10 years for that growth cycle to come around, there's 2 things, right? Inflation has eaten away your profit because your dollar's worth less now before it starts its next growth cycle. And the amount of negative cash flow you've had on that property, that let's say it was running 5-10 grand a year negative when interest rates were 3%. Now they're 5 or 6% and you're running at 20 grand a year negative. Every 5 years, you're losing 100 grand of cash flow. Sorry, in terms of you're actually losing it via cash flow, and then another 5 years, you're going to lose another 100. So by the time you get there in 10 years for that cycle to kick off again, you're already 200 grand behind the 8 ball just because of cash flow. What about how much that the inflation has eaten away your profit as well? Like, you're already starting probably 300 to 400K. Let's say I'm talking an 800 or a mil or something property, but you're already starting like realistically probably $300,000 plus behind the 8 ball. Whereas if that property had performed really well for you, and let's say you had bought blue chip and you had an excellent growth cycle, but you sold it out and you banked 500K, and then you went and invested that into 2 or 3 other deals. So you got your capital back out and then banked a 500K profit, or even just bank 500, whatever. You go and roll that into another 2-3 deals and then replicate that in a different market. Velocity of money, we'll go back to this again and again. Velocity of money, investing that into a different market, riding the growth phase there in the middle 10, in that 10 years of dead time in that market. And then you sell out again at the peak. And then you probably come back with another, let's just say 500 grand per deal. You come back with another $1.5 million. You get back in the market before it goes again. As opposed to holding that deal, being $300,000, essentially in the red before that thing even starts its next growth cycle again. You've made so much more money in a different market and come back. And that's, I don't know, we do another
I think what you're getting at, and it's a really important point, is because let's face it, time in any market is going to make anyone look good in a sense. Like, time's forgiving, right?
Yeah.
But the opportunity costs, and I think if we can really get people to get their head around, you should be asking yourself with any investment you own, what else could I have done with this money?
Yeah.
So you're talking about, correct me if I'm wrong, is you're talking about the opportunity cost. While you're holding on for that second growth cycle, which you've actually missed out on taking that cash off the table and putting it into subsequent 2 or 3 or 4, whatever, how many more deals that were further going to go into another growth cycle. That variance between the results that you would achieve by redirecting your funds as opposed to just sitting in that existing market is huge.
Yes.
And if you scale that multiple times, that's where you get to a portfolio like yours.
Definitely. You know what the honest truth of that is? This is being dead blunt about it.
Be blunt.
It is the difference
That's
between...
unlike you.
It is the difference between a passive investor, and in my opinion, a novice, a passive investor, and an advanced investor. Or aggressive investor, because like parking your money in there, you're losing money for that 10 years of no growth. When you exactly opportunity cost of being able to pull it out, multiply that somewhere else. Even if you either bring it back or you're multiplying it somewhere else to then do a sell down strategy and then take 500K from each deal and pay down 3 high cash flow deals. Bang, I own amount, right? See you later. I'm done. You know what I mean? Like that's what's possible. Or you hold it, and then in your 10 years, you're back to square one. You're already 300 grand behind the 8 ball.
What do you think it is that people? Why do you think people hold on to it for that second growth cycle?
It's because I think the big one is like people look at the entry and the exit costs, and they hear this age-old thing of their mum and dad. Never sell a price. Exactly what I was about to say. Never sell another property, right? Never sell a property. man, it is like the worst advice in investing you can do, because banking a profit can be so powerful. You know what I mean? Like, you literally, the example I gave before couldn't be any clearer with that, of you going from one and then sitting out for 10 years over that.
Yeah.
Like the power of what you could do. Imagine if you did that 2 or 3 times in your portfolio, the beast of a portfolio you'd have, as opposed to, I just held this thing forever.
Yeah. Which brings into point, and the question that some people will be saying, yeah, but I don't want to pay capital gains tax.
Easy. Let's just bust that myth straight away.
Another one.
Well, let's say in that example, right? Let's just say you've made a big gain. Actually, let's just say 300.
Big gains.
Big gains. The gains. Let's say you make 300 grand, all right? Just for a kind of a realistic number for probably what we work with bread and butters, right? So you do a deal for 300. Let's say she doubles, you sell her. You bank 600K worth of profit, okay? First things first, there's actually 2 things. Yep. Is it your primary residence? Primary residence, no tax. Let's say it's not. It's an investment, okay? Mm-hmm. You've owned it for over 12 months. Let's say you're getting in, you're getting out over like a 3-4 year window. So you've owned it for over 12 months. Yep. 12-month capital gains tax exemption. There's 150K, bang, go straight in the bank.
Exempt.
Yeah, exempt. Taxman doesn't touch it. The final 150K is taxed at whatever your rateable tax rate is. Yeah. So if you're sitting at 100 grand, you're going to pay, in the current tax environment, you're going to pay between the $100,000 to $180,000 bracket. You're probably going to pay your
38%,
35, 37, 38, whatever it is.
So let's call it 35.
Yep, you'll pay that in the dollar, and then for your extra, 70K over it, you're going to pay your 47 cents in the dollar, right? Probably should have done the maths on that before you drop that one on me, but. You're
paying tax on 100 grand. You're going to be paying 35 grand in tax. Let's just use it simple terms.
Yeah,
right. You're still coming out with a decent amount of cash.
Yeah, 100%. You're probably still going to be walking away with probably not that far off, say around about a 250 or a 230. I don't know. Probably work out the exact numbers. Yeah, but probably something around like a 230, 250 from a. Well, actually. Yeah, it would be that, because 150K is tax-free. It's just the remaining amount left over. So you're probably somewhere between that 240, 250 sort of mark that you're banking. Man, if I'm making 300K and I'm paying 50K tax, I'm all good with that. If you make 300 grand in a PAYG income role, you're probably paying somewhere between about 70 to 80K in tax. So instead, you're doing this passively on the side, and you bank that. You pay like half the tax in that sense. You pay half the tax on what you would if you were PAYG, and you earn that in a year, and you're literally banking that, and you go and you can roll it into other deals. Capital gains tax is just a cost of doing business. If it's, say, that circa 50K, but you're banking 250, you pay 50K tax, and like you're gonna be selling it at some point. You want to sell it at some point, because it's going to expedite the mission of what you're trying to do. It's going to ramp it up and make it go a lot faster.
I think the way that you invest, and when people are listening to you, you're working towards something. So you're not trying to avoid paying tax. And I often have this conversation with people. You can't win by trying to avoid paying tax.
Yep.
You can't. It's like trying to win a game of soccer but not scoring, right? So you're never going to win.
Yeah.
So don't think to yourself, my whole strategy is all around not paying tax. I don't want to pay capital gains tax. I don't want to pay this tax. You have to go out and accumulate.
Yeah. 100%.
So that's why when you're saying is by banking the profits and selling down, enabling you to get into another deal or another couple of deals is going to create a further opportunity to make more money. Yep. And yes, you might pay more tax down the road. 100%. But you're going to be buying, you're going to be making heaps more cash.
It's all part of making profit.
So I do have one more question for you, though.
Okay, mate.
Because you're talking about these properties for people listening out there thinking, okay, I get the foundational properties. Yeah. At which point do I switch over to getting more of the cash flow again? Just to re-emphasize that for people.
We'll run through that properly in the strategy sesh.
Nice.
That we'll do to get to a certain amount of income. But it's only when you're getting close on servicing. Sometimes with some guys, we've almost we know we've only got like 2 or 3 properties in the tank, and they don't have enough capital to actually get to a cash flow deal at that point. When we realize that, and we can build out 3 maybe lower level properties that we know we're going to have really strong growth, man, sometimes we just acquire them, we let them run, and we know we're going to hit a serviceability wall, but that's part of the strategy, because in the current interest rate environment, it can be quite hard to get around that with capital and whatnot. But like you look at Liam, and I know I'll go back to him again and again, but this is a perfect example of it. He's held a property for 3 years, he's sold it, he's banked 200. Now that he's got the debt back, now we're turning into trust, but we're going into trust with 200K. And he's put a bit of equity, so in after a little bit of tax, he's maybe about 150K that we've got to go into there and to then ramp his portfolio up in trust.
The reason why I asked you that question is because there are some buyers agents out there, or some people who believe that you should only be focusing on buying these, what they would consider bread and butter deals around that 400-500K mark. and just buy a whole bunch of them and just
Yeah.
hold them and not actually execute the manufactured cash flow strategy. So I think that's what maybe you'll keep your powder dry.
Yeah, we'll keep the powder dry for the cash flow out. But it's just like, in a nutshell of how to bang that on the head, it's like if you had two properties and one was at 500, they're both at 500K, right? But one's producing 8% yield, one's got a 4 or 5% yield. Like, which one do you want to hold at the back end? Which one do you want to sell to pay off the other? Which one do you want to hold, Jimmy?
100% you want the higher yielding one.
I'm surprised if your investing IQ
Because
that you got that right.
Well, I was a third tier investor apparently from last time. I thought, well, it's better than being a fifth. I think I was.
It's levels, bro. You were a level 3. Level 5 is better. You're still shit. But you get it right.
But you are right.
That's the idea. You want your bread and butter is it's a lower yielding. I don't like 4%, but let's say 5% plus.
Yes.
It's a lower yielding, higher growth. You want to make to summarize this as well. You also with the growth properties, you want to make. Like a lot of the time you'll make a bigger discount on the way into a growth property because that's what it's there for, right? So really to make the bigger discount, sometimes with the cash flow deals, you won't make as big a discount because they're in there for that part of the portfolio and for that part of the strategy. So sometimes you won't make as much. So the idea is to get the most desirable bread and butter style asset that you can for the best discount you can in the best location you can, ride it to the top, sell it off, bank the profits, guarantee you play that game, you win. You win. That's all it comes down to.
Couldn't have said it any better, Sammy boy.
I strongly believe that you could not as well. Guys, I think that's all we need. I think that's all we need.
It's a short and sharp. It's unlike you.
Mate, I wrapped you up quick. I think that's all we need. Honestly, if there's anything anyone else wants on that, we can go into more depth and in more detail on it, but I feel like we answered it pretty well, nailed it on the head.
You're flogging a dead horse.
Mate, beautiful. Sounds good. I've flogged you many times, mate. I will plenty of times more. Is there any bit of wisdom the 3,000-year-old silver dog wants to add?
No, I think you've pretty much nailed it. But understand the bread and butter deals are really important for you folks, and how it fits into your portfolio is something we're going to discuss a bit later on. But if you did want to find out a bit more about these kind of deals and how it could apply to you, then you could book in a discovery call and really get to see how that dual asset really works.
100%.
And how these properties play a really important role in your portfolio to get you to your goal. So
I love it, man. I love it. And if they want a discovery call, Jimmy, mate, where do they go?
Well, I think they should go to the Australian Property Scout website.
Wow.
Yes.
Wow.
Book in a call.
Book in a disco call, guys. Jimmy will dance for you live on the call. Put him on FaceTime. He will dance.
Absolutely.
But he's been likened to the Lebanese Zohan. He's got the same dance moves. He's got the same hip thrust. He's got the same fashion.
Yes.
It's very good.
Yes. He was pretty cool, wasn't he?
He was cool. He was much cooler than you. Anyway, guys, thank you once again for listening into the Scouting Australia podcast powered by Australian Property Scout Buyers Agency. As we said at the start, guys, if you took some value out of this, if you know anyone that would take some value out of learning about bread and butters, what they're in the portfolio for and why you're accumulating them, then send them this episode. Get amongst it, get around this. Subscribe, please, if you haven't already subscribed on your favorite listening platform. If you could also leave us a 5-star review if you haven't yet, that would be much appreciated. Now, guys, as always, any other questions as well, feel free. There is always in the show notes of this episode of whatever you're listening to this on, whatever platform, if you go into the show notes, you can send in any questions there. There is the admin, the Australian Property Scout sort of admin email there that you can send into, and we'll cover them on an upcoming Q&A session as well. Once again, guys, thank you very much for listening in to another Scouting Australia podcast episode. Jimmy, thanks again, mate. And until next time,